All right. Hi, everyone. My name is Elizabeth Yin, and I'm one of the general partners of Hustle Fund. Thank you so much for joining this morning. And I am actually so excited to be able to get these two guests, friends of mine, Brian and Andres, who are both successful entrepreneurs in their own right, turned investors. And in particular, we're going to be honing in on LatAm startups and starting out. We'll be talking about incorporation. We'll be talking about fun things like taxes. We'll be talking about mistakes that they made and things that they wish that they had done differently. And in particular, because both of them are investors, we'll get to learn the advice that they give their startups. And so that'll be really valuable to many of you who are thinking about fundraising from US investors or LatAm investors, or even just how you might like to take your company in the next few years. We're going to wait a couple of minutes for people to trickle in. But first off, before I hand it over to our guests to introduce themselves, just go ahead and comment in the chat, like where you are dialing in from. This is always a fun exercise. I love seeing where people are coming in from. And then we'll quickly get started. So I am in the Bay Area. And as we go along, just in terms of logistics and format, so first we'll do some context setting and introductions, and then we'll dive right into the meaty parts about starting your company for about 20 minutes. And then we'll use the remaining half of this session for questions. So I think that a lot of people will have many questions, and many of those questions may apply to many startups here. And so you can always feel free to use the Q&A tool or the chat here, and I'll try to pull the questions and ask Brian and Andres. Oh, it looks like people are commenting.
Yeah, Bernard is asking if we can enable the chat. It looks like people are smart. They kind of hacked the question here, and they went into the Q&A to answer.
Okay, smart. Well, I apologize about that.
There's founders on here. You can tell there's founders on here.
Yeah, that's great. All right, well, then we'll skip that exercise for now, and we'll just dive right into this. I would love to actually turn it over to Brian and Andres to give a little bit of context about who you are, what were you doing before, and what are you doing now? And Brian, why don't you go first?
Sure. So I'm Brian Requarth. I'm originally from California. Found my way down into Latin America many years ago. So I think I met Andres in Bogota, like, how long ago was that? 15 years ago?
Yeah, probably 2008.
Yeah. So I actually, my wife is Colombian. She likes to say she imported me to Colombia. So I was down there in 2004. I arrived there, did a bunch of entrepreneurial things to kind of pay the bills. Ended up having a terrible experience finding a property when I was searching for real estate. And so that inspired me to build Viva Real, which is kind of like Zillow in the US, a property kind of marketplace, classifieds kind of 2.0. And ended up scaling that business. Expanding outside of Colombia and focusing on Brazil. And we built that business for about 10 years. We exited the business in 2020 in a fairly good transaction. And for the last couple of years, I guess 7 or 8 years, I've been doing a ton of angel investing, primarily in Latin America. And so now I'm building Latitude. We're building infrastructure and community. So technically I am an investor, but my day job is the CEO of a tech company that helps basically build infrastructure for startups in Latin America. And then we also have a venture fund that we do early pre-seed and seed investing. That's me.
Very cool. Thank you, Brian. And Andres.
I am Andres Barreto, Managing Director of Techstars Miami. I am Colombian, but I moved to the US to start my first few companies. I started with Grooveshark, then OnSwipe, that went through Techstars New York. And then I've been an investor since 2013. I think it's going to be about 120 companies, investing across the US and Latin America. And now with Techstars Miami, we're also increasing the amount of companies we invest in from Latin America.
Very cool. Thank you so much, guys. So as you can tell, both of them have their own startups. They've worked with a lot of companies. So they've seen a lot. So actually, I want to just kind of dig right into this. Like, let's talk about incorporation of startups. So let's say I'm starting a business in Latin America somewhere. How would you recommend that I proceed? Because it's a little bit trickier than probably for US companies.
I think the answer is it depends, and I'll come back with a lawyer would do, which is, where are you operating this business? Where is your revenue coming from? Where are, do you expect your customers to be based? Where is your team based? So those are all things that you would need to kind of understand in order to recommend. I can share briefly about my experience as a founder and kind of what that looks like, and then maybe that'll set some context. Is that okay?
Let's do it.
So, like most entrepreneurs, I'm from California, and I found myself in Latin America, and I wanted to raise venture capital. And so, the advice that I got, which is kind of the advice that still is relevant for a lot of founders, depending on where they operate. I ended up creating a C corp in our company, which is definitely the vehicle that's probably most common and most attractive for majority of US investors. It's most familiar. Basically that I ended up raising money. We ended up raising about $74 million in the company over time. And when I got further along, I realized that, there's this little thing called capital gains taxes in the US, and I had zero operations in the US. And so when we exited the business, we had a pretty large tax bill that we had to pay over $100 million in capital gains taxes. So the kind of general wisdom that's like the immediate wisdom of like, you should do a C corp, which is kind of the answer that most people think, because that's what everyone does in the US. I don't think it's a one size fits all explanation of what should be done. And so today I ask a lot of questions about understanding the founder's needs, and then I try to give the advice accordingly. The most common structure for venture-backed companies in Brazil today is a Cayman holding company, and it's a Cayman holding with a Delaware LLC in the middle, which is kind of a buffer between that and then the local operating company. And so that is becoming more and more popular as kind of the market matures. And so that's kind of my quick overview of I don't know if Andres wants to add anything to that.
Well, the thing I do want to add, and I think I'll do it for the three of us, is that the views expressed here are not a reliance of opinion and are not intended to be used or relied upon for the purposes of avoiding tax penalties that may be imposed by the IRS, promoting, marketing, or recommending to any other party any tax-related matters. With that said, we're not tax advisors, we're not attorneys. Get your own tax advisors, get your own attorneys. And like Brian said, it depends. And that's like the lawyery answer. It depends. And also it's followed by, I'll look into it. And that's the lawyer and also the consultant hedging.
Thank you for covering our butts.
Yeah.
Elizabeth and I are very appreciative of that. Thank you.
Yeah.
Oh, the trainings that I get inside the Techstars for these type of things. So been drilled.
I want to dig into that in a second, and I'll turn over to you, Andres, because in a second. But so just Brian, just to be extra clear around what happened, you incorporated your company as a US Delaware C corp, and you also had a local entity. And then when you exited, as an American, I thank you for the extra $100 million towards our tax bill because you had that US Delaware C corp. Is that what happened?
Yeah, basically I had a global buyer that was a JV between a Norwegian and a South African company. And they're like, I don't want to own the US asset. And then but then they were like, but you're subject to capital gains taxes. So I'm going to buy the local entity, but you need to pay the taxes to the US because we're not going to take responsibility for the taxes after we make the acquisition. So we had to, we got basically slammed on the, from a personal standpoint and from a corporate standpoint. So we ended up paying that just because they insisted on us covering that, because the US government would go after us. US government is very good at collecting taxes anywhere in the world. And so it doesn't matter where you are, it's hard to escape. So yes.
Okay. So, and so you have a different recommendation. We'll jump to that. But Andres, I want to actually turn it over to you because I know that your advice may have some similarities and differences to your companies. How would you kind of approach the situation?
So what I tell founders, and I have to do this many times a year at scale, because we give offers to founders at Techstars, and then we have 2 months to fix everything so that we can actually wire the money and they can be part of the program. And part of like the value added that we have with investors, that any Techstars company has gone through a ridiculous amount of diligence. And so it's checks out. And so what I tell founders is, and I use the analogy of programming. You can build an app using Erlang and Go and Lisp, right? Or you could use PHP and JavaScript, or Ruby on Rails, what everybody talks about. One is more optimal, and Lisp and Rust and Go are super optimal, but it's also not practical in the beginning. And so what I've had to fix, and it's becoming increasingly frustrating, is companies that have a local entity, most of them do. And then at some point, somebody tells them, no, you need to flip into Cayman or Delaware, but they're unsure. So then they do a Florida LLC. And then the Florida LLC attorneys will create the equivalent of a simple agreement for future equity that is no longer simple, because they have to customize it to be able to make it for the future company that is not the LLC. So that's another $5,000. And then they have to get their local counsel. And I'm going to use Colombia just because I'm here in Colombia today. So that they have their counsel here in Colombia. They have their counsel in the US. And then they have to get counsel in Cayman if they're doing the flip. And they're $27,000 in. We write a $120,000 check, and time is running out. And then I tell founders, hey, separately, you want to fundraise? Be ready to get 99 no's before you get the first yes. There are no 99 funds in Latin America. And that's where the analogy of like using JavaScript versus Rust and Go comes in. I've also had companies that had investors that are not from the US, which there's plenty, but there's just 900 micro VCs in the US alone, whereas there's maybe 10 or 20 micro VCs in all of Latin America, maybe, but there might be more now. And so what I'm optimizing for is survival, like don't die. And I think there is a point where I've had the exception of the rule where it's funds that do not want to have anything to do with the US. And there's plenty of those, European funds or LPs from China, right? It's like a fund that has LPs from China, or it's some endowment fund that doesn't want to have anything, especially Europeans, don't want to have anything to do with the US. Or Asia, I'm not going to name a specific country, but imagine a mega fund that tell the founder, hey, I'm in, I'm going to lead your A round. All you have to do is flip. And they do a freeze, which I think that's okay. Like if you've survived to the point where you're doing an A round or a B round, and you do a freeze and you're going to pay Uncle Sam 20% of the freeze of the company when you did the flip, great, you survived until that point. You didn't over-optimize to get there. And then after 9 months of like wasting the founder's time and $250,000 worth of lawyers, the fund in the end is like, oh, we changed our mind. We're no longer investing. And so the founder had to struggle to put the round together in a week because everybody was panicking. What do you mean? What's going on? So I think the answer is yes, it depends. But I also want to be pragmatic and practical with founders, and I want them to survive. And the funding market right now is such that it's hard. And so I want them to have the highest chance of success by knocking on as many doors and creating as much FOMO, calendar density, and process so that they won't die. And when I see founders spending $27,000 before they've launched a product, before having product market fit, and they don't have the pedigree, right, that they can raise $5 million on a PowerPoint, that hurts me because it's like, man, that just delay that problem for later, survive. At some point, do the freeze if you never have customers in the US, if you're not moving to Miami, like all these founders are now moving to Miami, at least Colombia. Founders are moving to Miami a lot. You never see having customers in the US. You think it's going to be a local company buying your company. So that's what I'm pragmatic. And then the other thing that I'll finish off, and sorry for the rant, it's like really fresh in my mind. I had the Cayman lawyers say, oh, no, you need to ask local counsel. I had the venture law firm in the US, oh, no, you need to ask local counsel because nobody wanted to take the IP. It's like, you can't put the IP in Cayman. Oh, you can't put, like, don't leave the IP in Delaware. Like, just put it in Colombia. Do not put the IP in Colombia. And the reason why is because separation of power doesn't exist in our countries. There's no separation between judicial branch and executive branch. I'd had the superintendents of commerce shut down a company without due process, not shut it down, block the company at the ISP level without due process because Cambridge Analytica had 0.23% ownership in that company through another holding company. So rather than go to court and you argue in court, these superintendents, they have like superpowers. They're more powerful than any court. They're both the police and the judge. And they can shut down your company, take your assets, go after you without due process. So I told founders, whatever you do, don't have anything locally other than paying your employees and like the revenue. But when a country like Colombia was this close to charging the entrepreneurial tax based on your unrealized value of capital, that is very dangerous to have so much liability in countries that are very volatile politically and there's no separation of power. So even when they do the sandwich, which I don't mind, especially if Latitude is helping making it a lot faster and less expensive, which I love, don't leave anything in the local country. Whatever you can get away with not leaving in the local country, you can protect the volatility, the political volatility.
Thank you. Okay, so that's also a good perspective. So there's the tax optimization that Brian mentioned. And then there's the pragmatism of you don't want to spend too much out of pocket. You don't want to put the IP in the local company. And so I think just more concretely, what I'm hearing, Andres, is maybe you do start with a Delaware C corp that holds a local company and then fix it as you go along and you actually have a business rather than paying the legal fees up front. Is that your thought on that?
Yeah, and it's going to be expensive, but at least you survive to get to that day.
So it'll be expensive, but it may not be $100 million expensive.
Correct.
Yeah, and you can always flip into a different structure later. But my recommendation would be to do that earlier rather than later, because in our case, if we would have freezed our done the freeze, as you said, like said, okay, this is the value of the company. Now we're going to move into this other, Cayman structure. We would have had to pay taxes on the value at that time of the freeze. And in our case, it was $300 million. So we would have had to pay, $60 million in capital gains taxes. So you want to make sure that if you're going to flip into a Cayman or an offshore structure, and forget like BVI, forget all these other, just don't even think about it. Just like, don't get cute. Like there's basically, it's Delaware, Cayman, or the UK. Basically, if you're, and UK is like it's more costly and it's longer, and some fintechs do it, but like it's probably Delaware and it's probably Cayman for the most cases. I have one question. Let me just break down, if you're a founder, because we want to make this as practical as possible, right? Because there's so many variables. I think you need to ask yourself these 3 questions here. Who do I want to raise capital from? What's the size of the round I want to raise? And where will my company operate? With those 3 questions, it can kind of orient you. I mean, if you're raising just from angel investors, I'm going to say something that maybe Elizabeth doesn't like here or Andres doesn't like, but like, I might just pop in an LLC and have a local operating company instead, if it's only from founders. I mean, I've invested in LLCs. I will not invest in a Brazil Limitada or a Colombian SAS or a Mexican SAPI, but I'll invest in an LLC as an angel on a safe, right? And so I'm going to take Andres's idea, and I'm actually going to add to it and say, instead of a C corp, because C corps are kind of like as they say in Hotel California, the Eagles song, it's easy to check in, but it's hard to check out. And so once you start a C corp, it's actually quite difficult to get out of a C corp. And so I would actually alter. And so the first question is, who are you raising from? It's from angel investors. We'll invest in an LLC as long as there's a side letter that says there'll be an offshore structure created at some point, right? And so that's one way to get around. So we're actually evaluating so for those that don't know, we automate the company formation for Cayman, LLC, and a local operating company in Brazil, quickly expanding to the rest of LatAm. Happy to answer questions about that later. But the LLC might be an easier way and less expensive way of getting set up, just for you to get some initial capital from angels. And then it's easier to flip from an LLC into a Cayman company. Or if you want to do a C corp, you can also do a C corp if that fits your situation.
And just throwing in actually my thoughts on this, even though I'm the least experienced of the 3 here on this issue, as a US microfund or VC structure, traditional VC structure, we would not be able to invest in the LLC. And here's why. The LLC structure in the US requires, it's basically an LLC is a partnership. So when you have investors in there, they're essentially your partners. And that means at the end of the year, every partner needs to be filing tax paperwork on what happened in that company. even if you only made 2 cents for every investor. And so what that means is a VC fund who is also a partnership structure, and we have 99 investors in our fund, I have to issue paperwork for your company for a 50K check to all 99 of my investors, who then need to file it on behalf of you. So that's just a non-starter.
That's why I use AngelList, so I don't have to do any of that.
Well, so that's just sort of a non-starter for many VC funds. But for angels, they only need to file the paperwork for themselves. And so they may be willing to do that. No big deal. They're supportive of you. They know you, they like you, and they're willing to do it. So that's sort of the nuance between an angel and a VC structure, even if a fund like mine is writing the same size check as an angel like Brian. So that's just something to keep in mind. Again, there's, I think, no right or wrong answer, but I think Brian's framework of asking yourself those 3 questions is actually really important and a good way to think about it, because there's never going to be a perfect solution for this. Andres, you look like you're about to say something.
Yeah, and the other thing that we are very, very careful about is the QSBS, Qualified Small Business tax benefit that we get in the US that we won't get if it's like something else, which is significant as investors. And the other thing that I would add to like that criteria is, if you want to raise from angels, do you have access to those angels? Like, it's easy for you to raise angels. Like, I've seen founders raise from friends and family like $1 million, but the founders I'm backing don't have those friends and that family, right? So for them, I want to help them get access to as many funds as possible. But if you're also able to raise $1 million from angels, like, do whatever you want. It's also going to be more expensive eventually when you're like, all right, I have to do the flip, and now there's actual shareholders. When I have to fix an LLC, which just happens often, my first question is, are there any shareholders other than the founders? No, great, we can get it done in a week. There's other ones. And then I'm coaching founders on how to get there.
But what about with a safe though? Like, because they're not actually shareholders with a safe, right? And no one's going to actually sell interest in an LLC. You're gonna, it's for future equity, right? Like, is that common? Because I'd be surprised if anyone raised capital in an LLC and actually had shareholders in the company.
Oh, you'd be surprised what I see in LLC. Yeah. So that's when I have to fix an LLC. Basically, if they have anything that has outside shareholders, and we have to fix it, it's going to take long. If they have nothing, it's going to be easy. And if there's also the founder that can raise a $2 million on a PowerPoint from a top VC like Andreessen Horowitz, Sequoia, Kleiner, whatever it is, and $5 million in Cayman from day one, that's great. That's typically not most of the founders, at least that I work with, that have to struggle to get 200 meetings so that 2 of them will say yes.
Yeah, and so again, it depends on your situation. And I think actually Tomas brings this up in the chat, pretty well. I think that more or less is the framework. I think I would ask yourself, do you have friends and family who can be angels? And if the answer is yes, I agree with Brian. Actually, even if you're a US company, starting as an LLC is generally more favorable to you, because you can always flip into a C corp. And if you don't make money for the year, you don't have to pay extra fees or taxes, unlike in a C corp. But if you do not have access to those angels, the benefits start to go down as to why you would start an LLC in the first place. You may want to actually just go directly to the C corp. So again, it depends a lot on your particular situation.
Yeah, I do think we need to also flag the Cayman here, because like, if you look at Kazek, one of the leading venture funds, or Monashis or Valor or a lot of these other larger venture funds, like they all want to invest in Cayman companies. Like they're all requesting Cayman companies, and in many cases, so like, and you don't have to go into that with the right structure, because if you're small enough, you're just going to pay a lot in legal fees. So one of the reasons why we decided to, I'll tell you the math on this, because if you want to create a Cayman holding company from the scratch, it's about $35,000 on average to do it from scratch, which, as Andres pointed out, that's absurd, right? If you're raising 100,000 and some change from Techstars, like, don't do that. Like, that's like Andres will tell you, hire the key people to validate your business, grow your initial user base, whatever it is that you need to get going. But if you're able to raise, a little bit more money, doing it earlier is more effective. We've been able to bring the cost down to about $6,000 or $7,000, so it's about 4 or 5 times less expensive by automating a lot of this stuff. And all the founders listening here, like, no one really wants to spend a lot of time with lawyers, right? So, hopefully creating that in a more efficient model. But just be careful when if you go to like Stripe Atlas and you create your C corp or your LLC. Those templated documents, they're not designed for LatAm. And then you're, like Andres said, you're going to have to, go in and he's going to have to fix it for you when Techstars wants to invest. So, those are just things to think about.
I think the companies I've seen doing Stripe Atlas C corp, they pass through flying colors. When they do the LLC, it's the fixing. And if the founder has access to Kazakh monasteries valor and can create momentum and scarcity from 4 funds, go for it. The reality is that
there's more than 4 funds though, Andres. And like,
there's no 900 though. There's no 200.
But there's a couple hundred. And
then those funds are the ones that are saying, oh, our minimum check size is 5 million, or we'd like to see more traction. Who else is on the round?
No, I don't think so. Like, we've done 100 deals in Latin America in the last 18 months. And a huge percentage of them had, follow-on investors from an array of, I can name 20 very quickly right now without having to think. So I think, it's not I think you're right if it was 5 years ago or 10 years ago, but the number of new funds, I mean, at our last demo day, we had 500 VCs there at the demo day. So like, this is, so 200 isn't even the number anymore. So I think that the ecosystem is maturing. And, I think that you want to be set up the right way, and C corp isn't bad, and it's not a bad thing to do, but I'm obviously partial to Cayman, and my money that left my bank account can verify that, because, it scars you a little bit when, the company loses $100 million in value. Right. So it's just something to think about. And so it's not the wrong answer. And in some places like Mexico, it's less encouraged, the C corp, and it's, because Cayman is like not as common there. But if you're in Brazil, Colombia is another place. Like, most companies that I've seen that are getting, and you want to attract the investors, right? So like, if you look like a great company because that's the companies they've already invested in, you're gonna kind of signal the market like, hey, this is a company that is set up in a way that is going to attract venture capital, because this is how the other companies you've invested in look. So that's another, like, kind of a mentality shift in how to think as a founder,
So maybe doing the switch before pitching investors, if you need to make any switches, I think is the general advice I'm pulling away from here. So I want to actually switch gears slightly, because I think people then have some questions like, well, how can I get any of this done cheaply? And I think one of you actually mentioned Stripe Atlas is pretty good. We have a company called Doula that does incorporations. Do you have any other suggestions around who might be able to help people for relatively inexpensive price on this sort of thing?
I would be careful with
Latitude?
that also, because I have seen the documents of many lawyers that try to do things cheaply, and it ends up being more expensive later for the big boys to fix. So I would definitely look at other platforms. I want, and I love what Latitude is building so that it's cheaper. Brian, at some point you're going to get it to under 1,000, right? You're on mute. You're on mute.
The Cayman is impossible to get under 1,000 because it's the filing fees. But yeah, I mean, look at, como dicen in Colombia, no, lo barato sale caro, right? Like, the cheap will cost you a lot later, right? And so, listen, let me just tell you the backstory on this, because I've created, 6 or 7 companies before. I've invested in 150 companies. It is just the most, like, mindless, mind-numbing activity, talking to lawyers and getting your company set up the right way. It takes, I was looking the other day as I was talking with our team, I went through emails and I had 186 email exchange with our law firm. And they're a very good law firm, but there's attachments, you forget something. And so, I think that We don't have a solution for the entire market, but I'll tell you right now, one of the products that we want to build is we want to automate the company formation for 80% of the venture-backed companies in Latin America. So right now we're servicing Brazil primarily. We'll be launching a product, probably the end of this quarter or Q1. So we'll be able to service Colombia and Mexico. And I hope by next year, every single company will be able to start their venture journey on Latitude at Latitude Go. I dropped a link in there just so you can see it. And, so this is like, it's such a painful process. So there's nothing wrong with those existing, if you're creating a C Corp and that's the way you want to go, like Stripe Atlas is, the company you mentioned that you invest in. Also, I've heard good things. It's what's it called?
Doula.
Yeah, Doula. Yeah. So like those are all, it's pretty standard operating, when you're creating a C Corp. The problem is if you're, if you're creating a C Corp and long-term, it's not the best structure. And then, you need to flip. I mean, my friends at Creditas, they flipped from Delaware to a Cayman. They did it early enough where they didn't have to pay a ton of taxes. Corner Shop, that company was a C Corp, or was a Cayman. Like Nubank, Cayman holding company. So like, I know that I'm kind of preaching the Cayman, but like I'm pretty passionate about it. I'm building a business around helping people do this because I see the potential pain that you can avoid, in your pocketbook.
Okay, so with that, and next time we'll bring you on as a sponsor of these things for Latitude. No, I think everyone should check out, some of these resources, but I think to Brian's point, depending on your situation and the complexity, you may also want to go with a traditional lawyer. Let's go to some questions now, because there are a number of them kind of starting to pile up. One asks, if you intend in the future on having some percentage of sales or operations in the US, is there any point to the Cayman sandwich? Or talk a little bit about that, especially since we are talking about Cayman right now.
What I see most companies do is Cayman holding company, Delaware LLC, and I can explain the buffer, the reason why you have that local operating company. You then throw a Delaware C Corp underneath the Cayman holding structure. Again, back to the original comments, I'm not a accountant or a lawyer. So if you can't, blame me if this doesn't work for your specific situation. But what I've seen companies do that are global is that they have the Delaware C Corp sitting under the Cayman. And then if they spin off that part of the business, someone can buy the Cayman, the Delaware. And so that is the more common structure. So if you're a company in Colombia and you're selling into Latin America, and then you decide to enter the US market, and if you have a Cayman holding company, you can create a C Corp that sits underneath the Cayman holding company. Again, talk to lawyers, talk to accountants, but I've seen that multiple times. And that way you have the protection of the Cayman, it's Commonwealth law. It works just like a C Corp. It actually is like almost a mirror image of a C Corp. You can have stock options. You can have all the traditional benefits that you have of a corporation. You just have the tax benefits. So that's my kind of, if you pay 2 cents for the advice, it's, that's what you get. So, but that's what I've seen other companies do.
Great, thank you. And this is a related question that actually we had already started talking about, but I really want to hammer it home. Are VCs willing to invest in companies with this structure? And I think actually, Andres, maybe you can spell this out. Like, what kind of VCs are investing in what kind of entities, just so that people know?
So what I've seen a lot of things happening recently is that you have a lot of US VCs that are starting to invest in LatAm, but they don't have like necessarily a LatAm partner or a LatAm expert. They just see the opportunity and they're starting to invest. They also don't have a LatAm dedicated fund. And those are the ones that are accelerating the speed to close a round. And now LatAm is already weird. And you're probably trying to explain to them, that you can get things through WhatsApp in LatAm and that nobody uses the web. It's all WhatsApp. That's really weird. And then you say, and we'll have this Cayman sandwich. It's like, okay, cool. Let me look into that and see how I can figure that out. And then they'll invest in another company. But the VCs that have a practice for LatAm prefer Cayman, or if they're based in LatAm and have LPs, like their thesis is LatAm. Cayman is better than Delaware because that's part of their thesis as well.
Okay, cool. And I would just sort of add to that, like, micro VCs like myself who are US based, although, we do invest in LatAm, I would say that we're fairly new or unfamiliar with many of these crazy structures that we're talking about. So I think, for our peer group, if you're trying to pitch to micro VCs, the more US friendly, like makes it easier for people to get involved without having to do this extra research, which is just one more friction point. But to Andreas's point, like, people who invest in LatAm all the time would be completely familiar with, the sandwich that we're talking about.
Yeah, I would look what the follow-on investors. I mean, for you and Hustle Fund, you come really early. We've co-invested on some stuff together, and I would just look at who the ideal follow-on investors are, and then find out what the structure they prefer. And if they're local VCs, most likely. I think today, it depends on the country, but most of them, accept the Cayman or prefer the Cayman. But I would just check with the other VCs and see who would be the follow-on.
So, okay, here's a follow-up to that question. Are you seeing multi-stage US VCs, so not their LatAm arm or anything like that, but US VCs investing in LatAm companies? And if so, is it with this kind of structure?
I've done 10 deals with Andreessen in the last, 6 to 8 months. So they don't have a LatAm dedicated fund, but that's a perfect example. And, and I'm sorry if it came across as a commercial. I'm passionate. Passionate about the topic because, I had direct, impact from this topic. So like I speak about it with some passion because I want to make sure founders have, as much knowledge as they can about this. But yeah, this is one of the reasons why Andreessen actually invested in our holding company. Andreessen and NFX so as an explanation, we have a holding company which basically builds software to reduce friction for early stage founders. And then we have a venture arm, which was an extension of my angel investing. And so on the holding company, we raised a seed round from Andreessen, NFX, David Velas, and about 125 other founders. And for that's why we're building this automated company formation product. And so I think NFX, Andreessen, all of the global investors that are now poking around a bunch, some of them, when they start going down, it's just like what you said, they prefer a C Corp because they're familiar with it. And they do 1 or 2 deals. And then they realize that they have to pay the legal fees when Kazek comes in and follows their seed investment and writes the Series A check. And Kazek prefers the Cayman structure. And so then they're quickly learning fast because they see that $50,000 in legal fees just, flew out the door. And, they should have just done it from day one. And so I think that as investors learn a little bit more by doing more investments, it becomes a little bit more common. Again, it's not the end all answer. As Andres said in the beginning, there's no one size fits all. But it's just like one thing that people kind of underestimate.
But let's really poke at that a little bit. Like you're saying that Andreessen Horowitz is now investing, or at least has before, in this sandwich structure that we're talking about.
Not only are they, sorry, 1 second here. Not only are they investing in this companies with this structure, I just hosted an event with them in Sao Paulo on Friday, and it was, it was a bunch of co-investments that we made there, and they were there to talk about their experience in this structure. So like not only that, they're promoting it, and they're investing in a company that's also building a product to reduce the cost for that. So I think that given that one of the largest global investors that has done 14 investments in Latin America in a very short amount of time, and it's going kind of heavy in the region, and hired a partner that is from Latin America in Gabe, that they're like investing in a company that's trying to promote this to the early stage founders. It's a pretty strong signal going beyond just doing a few investments. Yep.
Okay, that's actually a great data point. Are you seeing other firms? You alluded to NFX, they're in your round. Have they done something similar, or any other firms, or are we just saying it's still early days?
If I pulled up the list of companies that we've co-invested with recently, I'd say majority of them are one, it's not that they're not investing in C Corps, but a lot of them are preferring that. Founders Fund, I did a deal with Founders Fund and General Catalyst recently. It was in a Cayman holding company, or they flipped to a Cayman. Who else? QED, another fund. So I'd say that all of the rather well-known funds are in Latin America, and it's hard to bucket Latin America into one, region.
Sure.
So like, it's unfair for me to say Latin America because Of course, there's like very specific examples, of a couple countries where like that maybe doesn't hold true. So again, we're trying to give information without like, misrepresenting an entire region. But I would say that it's very common, and it's the ones that have done multiple investments have realized that, again, if you want the larger, if you want SoftBank or a larger fund to follow, a lot of those times, they're investing downstream. And so, but again, there's other examples where it's not perfect. So I feel bad about giving general advice,
Yeah, no, but I think just having these data points is helpful for people that actually US VCs are investing in this structure. Let's go to questions again. So slightly different topic, but related. Let's say on the exit side, so not VCs anymore, but on the exit side, does the structure matter for buyers, like for an M&A process? And like what kind of buyers is, more conducive to a particular structure, if you know?
Go ahead, Andres, if you want.
It's a lawyer answer, right? Like it depends.
Sure.
But before answering that, I think the number one rule that everybody mind is survive at all costs, right? Like number one, just survive, and then do the optimization. For the acquisitions, there's like two types of companies I see in Latin America. There's the companies that are made in LatAm but sell in the US, like their market's the US. There's not that many, but there's there, and then they're more likely to be acquired by a US company. Then there's the companies that are in LatAm, selling in LatAm, and then I think that if the company becomes large enough, there's going to be fewer buyers in LatAm, and there's probably going to be more international buyers from elsewhere. And then the world is no longer limited to the US. So it really depends, but I do see both.
Yeah, but let's say you have a buyer who is an international buyer, but not a US buyer. Does any of this matter to them, or do they just not care?
It does matter, but Brian has those cars.
I'll tell you my perspective. So first of all, there's a couple ways to look at this. One, if you're a global buyer and you're not in the US, when you buy a C corp, you're gonna, there's the capital gains taxes, right? And so, so that's obviously unattractive. If you're a UK holding company or a German media group and you want to buy a company in Colombia and it's a C corp, like you're just going to pay taxes in the US, and like that is kind of annoying for the founders, and it's also kind of annoying for the acquirer because like less proceeds, et cetera. So one of the reasons why the Cayman structure exists, and the reason why it's a sandwich, not just like a tostada or a open face sandwich, it's got 3 layers here. And it's because the LLC serves as a buffer. So let me give you a really poignant example of this. Corner Shop, who I'm close friends with the founders, Oscar and Danny and Chaqueta, the third founder, they went to, they had Walmart that went to go buy their company that actually fell through because of antitrust. And then shortly afterwards, they got scooped up by Uber, right? For $3.8 billion. So as a little bit of why the Cayman structure was very favorable in that situation is because when you're making an acquisition and, they could have bought any of the 3 entities. But what happened was when antitrust went to go look at it, they went to, and I hope no one from antitrust is on this call, but I'm not giving them any ideas here. But what happened is they looked at it and they saw that there was a holding company in Mexico, the operating company in Mexico, and there was an LLC above it. And so they wanted to like diligence on who all the shareholders of the organization were. So if it was a C corp, they may have gone back and then wanted to say, who are all the shareholders in the C corp? And then they want to audit the shareholders of the C corp. But instead of needing to do that, they just went and they looked up and it was one LLC, it was one owner, and they didn't go another layer up to look at the Cayman holding company. And so it dramatically reduced the friction of the acquisition. So that's one thing. So when you have this Cayman structure with the 3 layers, it provides you, let's call it optionality or flexibility on what entity you exit. So that's one of the reasons. And then also the other reason I mentioned is the kind of who's part of the shareholder structure, and then kind of the ease of getting the transaction done. So those are 2 reasons, and that's aside from the taxes that I already mentioned. So there's kind of three kind of reasons why it kind of makes sense if it's a global buyer. But there could be a local buyer, And it could be a Brazilian company buying a Brazilian company. And, then, they wanted, I saw with, I think it was with RD, which is Resultados Digitais. They were a C Corp, and then they flipped to a Cayman. And then in this case, the buyer wanted them to change to something else for whatever reason. So again, that's why we had the disclaimer at the beginning here. But these are edge cases in most examples. And I think that the example I gave with Corner Shop is a pretty good one, and it's more consistent, I'd say.
Fair. And then aside from acquirers, there are questions also about potential partners or, business partners, either in LatAm or elsewhere. Does any of this matter to them?
I think that matters a lot less. The only time where it does matter is when you have a distribution partnership or like a reseller type of deal where there's tax withholding for money leaving the country. And so then they want a local entity that they can do the invoices and pay and offset the taxes. But you can always do that with subsidiaries while not keeping the IP or exposure to regulatory entities or police that are also judges. And even on the antitrust, or at least in Colombia, I've seen that they want to go as far as the person. And because they're both the judge and the police and the enforcers, they'll do everything they can to get past. And when they hit the individual person, that's when they feel satisfied. But hopefully they're not watching this.
All right. This is being recorded, but anyway. Okay, well, that's helpful. I think, a lot of there are a lot of questions about people's particular situations. And so I'm not sure we'll quite dig into that. But I think one other area, at least from a US perspective, that I want to touch on this call is for US investors, we have to think about something called PFIC, P-F-I-C. And I don't know if you guys have run into this, but essentially what it is if we are investing in an entity outside of the US, so it can be anywhere, not necessarily a Cayman structure or Singaporean structure or whatever, like literally anything other than the US, if that company has raised a certain amount of money or has achieved a certain level of revenue or profitability, then we and the company have to file additional paperwork in the US. And the reason for this is the US does not want money laundering overseas. They do not want US investors, or whomever putting money into weird holding companies overseas to evade taxes. So that's why they do this. And this is actually kind of a bit of a pain in the side for us at Hustle Fund when we invest abroad. Do you guys have any thoughts on this? Have you had, VCs either complain about it or you've run into these situations even within the company, they have to do additional filings in the US?
Seen VCs complain about QSBS, not this one in particular, but something that we get drilled down in Texas is also CFIUS,
Yes.
where there's a certain amount, and the head of compliance would be mad at me right now because I don't remember by heart, but I think it's like 10% of the company cannot be owned by any investors. Doesn't matter like if you have LPs and they'll go down to like the LP, except Canada, UK, I think Australia and the US is fine. Everything else that's outside of that, it can become a liability. And there's people in CFIUS right now going through PitchBook, through Crunchbase, looking for targets. And the fine is the size of the round. They can undo the investment and also fine you the size of the round. And so if you're going to avoid the US market altogether, I wouldn't worry about it. Like no US customers, no US investors, no US anything, I wouldn't worry about it. But if you are, it's just don't cheap out on lawyers. And like the lawyers charge $1,200 an hour. Negotiate with the law firm so you can do deferred payments. But like this is the type of stuff that you don't want to mess with because it's also a personal liability.
So I'm just going to spell out a couple of things that you mentioned. You mentioned QSBS and CFIUS. So QSBS is a way for the US to incentivize US investors to invest in US companies, small businesses. And basically what happens is if US investors invest in small businesses that fit a certain criteria, most startups, and hold on to their stock for over 5 years. And then let's say the company exits and the investor gets liquidity, the investor pays no US national taxes, which is incredible actually for US investors. So this is one reason why US investors love investing in US entities, because you can actually you don't pay a lot, you don't pay any taxes compared to other asset classes if you hold on for that long. So as a pre-seed investor like myself, most of our companies that do exit after 5 years, and so this is beneficial for investing in US entities. So that is a consideration for US investors. CFIUS, which is CFIUS, I forgot what it stands for, but basically the US government does not want what they call rogue countries or people from rogue countries investing in US companies to basically steal trade secrets and technology and take it back to their country. And so, I think, in all honesty, it's a little bit silly for most web startups, but this is what the world has come to. And so if you have a US entity and you have foreign investors who may be perceived to be rogue and own more than, I guess, 10% of the business, I'm not quite sure on that either, but a significant portion of your business from investing in it, then the US government may do all kinds of things to you, including fining you, and in some cases may even seize your company. But I believe actually the law is unclear on that. So just something to be aware of if you are incorporating in the US for CFIUS.
I hope we don't scare all the founders on the call, but I mean, really, if you're afraid of this, like, just wait till you're building your company, right? There's many challenges along the way, right? And you got to be resilient. I wanted to ask you a question, Elizabeth, and I'm going to take the question from the chat here. David Echeverria, we already know that just to recap for Hustle Fund, I think it's important for all the founders listening. You don't invest in LLCs, which is important for the founders to know. And you invest in C Corps, I know. And do you invest in Cayman just out of curiosity? Do you invest in just those two types of entities?
Well, I'm using this webinar to figure out our strategy. So this webinar, if not beneficial for other people, is certainly beneficial for me. She's brilliant, by the way. If you don't follow and read her content on Twitter, everyone here needs to stop and follow Elizabeth right now as you're doing this. And you're so smart because you're just learning, and then you're also teaching at the same time, which is like, I'm kill two birds with one stone. We can all learn. I'm a big fan of your growth strategies, so it's great. So sorry to interrupt you. Thank you, but I think actually some people did ask that question. I think the honest answer is Hustle Fund has on occasion invested in other international entities. I feel like we've done that very slowly because of the extra paperwork we have to file. So the bar actually has been extremely high because, for a 50K check, we have to spend a lot of time filing extra paperwork here in the US with our US government for investing in international entities such as PFIC, which I alluded to before. But I want to try to figure out a way to streamline that so that way we can invest in, let's say, Cayman entities at scale. But I would say to date, we have not done that. They've been sort of one-offs. That being said, if you are a LatAm company and you are a US Delaware C Corp, we treat you the same as any other US Delaware C Corp. So that has been really easy for us to invest in. Yeah. All right. Well, I think we are actually out of time. Thank you all for joining us. And I really appreciate you taking the time, Brian and Andres, to share your stories, your personal war stories, and your perspective on this. I've certainly learned a lot, and I hope that everyone else has as well. Thank you all.
Thank you so much for having us. It's fun.
Take care. Bye.
Bye.